What's up, everybody? Welcome back to another 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano, and today we are talking once again about interest rate changes. That's going to be the front and center of our discussion here before we get into talking about some of what we might be expecting for GameStop into the end of the week. So that's coming up today. We will, as always, start with our gratitude. And today's gratitude goes out once again to Samuel Bowser for sponsoring today's newsletter and video breakdown, as well as to our monthly supporters, Not Medical Advice, Master Kurt, Lusco, Cosmotropic, Dayswag52, and Hey Luckies, aka Faithless Looter, who have generously and continue to support the channel on a regular basis, on a monthly basis. Thanks as well, of course, always go out to everybody. All your questions, comments, pointers, everything, right? Everything is valued here. Everyone who contributes to the channel is an important part of the community we have here at 21st Century Renaissance. So thank you very much to all of you. Today, I should say really yesterday, right? What really caught my attention, I kind of knew automatically what we were going to end up talking about today, was what happened right here into the close, as well as what happened right before it, which was this conspicuous about pop-up of about 3 to 4 percentage points of Schwab Composite IV. So these two things, right? We've been sitting around, we've been saying, okay, when are we going to get some volatility coming back? Thought there might be a good chance for this week. Maybe popping up for reasons we did not anticipate, but nonetheless, we do see a little bit of movement here, which is always nice to see after a number of days of looking pretty flat. Number of weeks, we should say, on top of that. But, I really want to call our attention, especially to this great post, right? So earlier in the day, I had noticed, right, that the odds of a rate cut coming for September 17th were ticking up. I had made a post over on Twitter casually, just sort of saying like, wow, that's getting pretty high. I think we topped 94% odds of a 25 basis point rate cut. And then later in the day, just before, so about an hour before close, Altimeter 5, the Altimeter 5, of course, put up this chart looking at the yearly change, the expected yearly change for federal, U.S. Federal Reserve Bank interest rates, popping up another 50 basis points, right? So the idea here being, of course, that these types of changes, and Altimeter 5 has been talking about this for a while, these types of changes likely are what influence dynamic movements connected to various baskets of small and mid-cap equities. Of course, right? Small and mid-cap equities act as volatility engines. They are, let's say, gateways or kind of capture devices for profiting off of volatility, of course, by sort of churning volume. Let's say internalized volume through these types of stocks and then profiting off of their price movements in the equities market, right? Of course, the blue chip stocks, they get to grind, they get to look nice, they get to go up and to the right. Same thing with index funds, of course, but there's more freedom to allow instability and volatility in small to mid cap equities. Of course, they can be shorted. Their prices can be explained away, their price action can be explained away as the result of speculative factors and the like, of course, because they have, it takes lesser money to move them around, of course. Institutions can move these around essentially at will to certain great extents and then be able to manipulate and take advantage of this price action via the options markets on these stocks. And of course, be able to take advantage of retail that comes in at a significant disadvantage and uses disadvantaged instruments in order to go ahead and try and do the same thing themselves, often with poor results. I certainly, experienced this my first foray into the market, into trading derivatives. So, this is a very typical experience. But of course, another element to this is that large institutions are using these in order to build interest rate swaps, right? So use synthetic derivatives positions in order to balance and hedge their exposure to the federal interest rate. So when this interest rate changes, this often stimulates significant rebalancing and hedging across a whole basket of small and mid-cap equities, which Altimeter's done a really great job writing about. I'd really highly recommend for a more detailed breakdown of this, do check out his post I did discuss this. We did have a conversation about this. I did put together a lengthier discussion in my video and article from May 7th. So in my article, I have these links. So the May 7th breakdown of this in relation to Bank of Japan cuts and forward guidance for the Federal Reserve Bank going back to May. So I have that article linked here. Definitely go check that out. I also have linked a number of Ultimator's posts that talk about these dynamics as well. Some very helpful graphics he put together. And then if you want to check out the video, I'll put these things down in the description of this video as well. Right, this is a video about the first 19 minutes, after we do the thanks. Of course, at the beginning, about the first 19 minutes up to around the 19-minute mark, I go into depth discussing and breaking down my thoughts with respect to this dynamic and its influence on GameStop. So if you did not have a chance to check out that video, if you're relatively new to the channel, if you weren't necessarily with us going back to early May or even a little bit before that, you'll definitely want to go check that out. But the gist, which I'll say here, right, is that what seems to have been the case around midday going into the later day is the probabilities for a rate cut for September 17th changed quite dynamically as a result of forward guidance given by Treasury Secretary Scott Bessent. So midday, right, Scott Bessent basically came out and said, yeah, we're thinking about doing not a 25, but a 50 base point cut to the Fed's target rate. And we can see here, if we take a look at FedWatch right now, we've got the probability of at least a 25% rate cut, or excuse me, a 25 basis point rate cut is at 99.9%. It is essentially guaranteed. The market is saying right now the Fed will cut rates on September 17th. That's happening. With a small chance, and this is what we'll be watching, of course, is the estimated likelihood of a 50 basis point rate cut coming on the 17th. So you'll remember going back to last year in September, this was the type of phenomenon, right? There was a surprise 50-point base point cut at the meeting on September 18th. And this does look to have been the inciting event for GameStop's 20 million share quarter three at the market offering to have been bought up. That's where a lot of this volume looks to have come from. Some of it may have been connected to some other factors as far as rebalancing of, say, swaps, maybe an exiting of a swap, something like that. But it does look to have been possibly complicated by that surprise 50 basis point rate cut. So that corresponded certainly in September, but also at the November meeting and the December meeting to significant bullish episodes, right? So bullish upward volatility in GameStop within the 2 days immediately following the announcement of these rate cuts. So that probability is now basically locked in, and it does look like both the introduction of this kind of midday volatility. So all of a sudden, right, for about 3 hours here, all of a sudden we got a pretty big noticeable volatility, that is implied volatility hike in Schwab Composite without really anything going on in GameStop's underlying price action here. I mean, our 200-minute moving average was kind of moving up throughout the day. But then once that came back down, it came back down to baseline and even sort of lowered later in the day. Price action, of course, saw some of that volatility convert into about a 2.5% bull run into the end of the day. That stopped just shy in after hours of that $23, what we would say right now, call gamma exposure wall. So very interesting to see that pop up. We'll have to see if there is more of this coming now, right? What we may have seen, if not right now, okay, there's a 0.1% chance supposedly of the 50-point cut coming. But that 25-point cut is now, essentially guaranteed. So is what we saw institutions going, okay, we're definitely getting a cut. We're definitely getting 25 points. So let's reposition and hedge interest rate swaps with respect to that. And was some of that external buying that we saw take place toward the end of the day yesterday the result of that? It seems to be that was the case, right? And especially seeing Ultimator post about this several minutes before this ended up playing out was quite interesting to see. So meanwhile, all of this is, of course, occurring. We're keeping our eyes on the publication right now of 13F. So we are seeing more accumulation. We saw over 2 million shares here of additional position accruals with respect to GME, as compared to about 5 to 600,000 to the downside. So Schwab and Nuveen reduced their position sizes up to June 30th. Doesn't mean they reduced it in July. They may have then added them back in July. Who knows? Maybe they cut these shares, right? Because this could be, right, that they cut, let's say, during the Bitcoin run up, and then they added to their positions thereafter, something like that. So we see that, but we also have a number of major institutions such as State Street, Renaissance Tech, Susquehanna that we haven't seen yet. So we'll be keeping an eye out for them, in the next couple of days. By Friday, they've got to have their 13Fs up. So very interested to see what we see from them. Options wise, we did see a slight pivot in what we're used to seeing in terms of what the options market typically looks like. We're continuing to see the contraction of put positions, modest. It's not tremendous. It's mixed sentiment. So we are seeing put contractions on that side of the chain. In the money options are coming off the board, which is interesting. The second straight day of seeing that. And around the 22.5 up to 24 range, slightly above as well, we are seeing new positions open in the very short term that do skew bullish. So we do see some traders coming in and net betting on this week something of a continuation of that potential bullish trend and some volatility. So remains to be seen exactly what we'll see there. Gamma wise, I will say before we move on to our gamma discussion, we did also see some more modest, about 2 million in net premium. Some of these deep in the money short put trades that are offset by qualifying contingent trades. What Can I Make Today has been really good about talking about these especially. But what it seems over the past several months is this is a new tactic that's been put in place in order to dampen price action, to dampen volatility and control the price on GameStop, especially while that is possible ahead of, let's say, settlement events or institutional repositioning with respect to, say, interest rate hedging. And what we see going on here, right, is the idea with this trade is, okay, it's a deep in the money short put. So an institution is going, okay, they're selling these deep in the money puts, which basically act, right, they can't profit really off of volatility much. There isn't really that much IV built into these. They're not really going to benefit too much, right? They're so in the money. The deltas are 1. There isn't very much premium otherwise built into these. So they're probably not trying to make money. Like, this is a huge, this is a big trade to make for a comparatively small amount of premium that you would make. So it's not a really great return there. These can be used in order to leverage interest rate. So you have a kind of synthetic stock position here that where your downside is protected essentially by leveraged exposure to the interest rate, because you're holding cash that's been given to you by the options market maker. You can be assigned basically at any point by the options market maker if they want their cash back. They can just kind of make you buy this. But what seems to be the case, right, and we can see this where we have the first of these, which is, it's labeled mid, but of course it's a none side trade. The bar is white there, mid/none side neutral, not labeled as none here, but in any case, this looks like it's like a qualifying contingent trade, which means that as this came in, there was also a floor order for shares that came in, and likely what happens is this is offset by the seller of these puts going ahead and shorting stock in order to remain neutrally exposed to the underlying. Now, what that does is that then offsets the options market makers hedging in response to this. So normally this type of options trade would cause a bit of an appreciation in the underlying, as the options market maker would go out and purchase shares that would, in order to hedge their own position. But with this qualifying contingent trade, this particular trader has then gone ahead and hedged their own exposure, therefore by supplying the short shares to the options market maker to pick up. So essentially, this trade happens, cash gets transferred over to the short put seller, and the price goes nowhere, right? So these kind of flow in, and when we see these flow in, they're of such a magnitude that it ends up dampening whatever is going on with the price intraday. So we get this kind of muffling effect on our price action, which of course crushes volatility. So if you're also short calls, for example, if you're short options in general, kind of letting these short puts flow around has this effect of dampening volatility, interestingly. Gamma wise, right, we do see that $23 position has now gone ahead. We are at midweek. We have had substantial decay with respect to the total delta and gamma values of our out of the money contracts, especially because of how low IV is right now. It is still on the lower side, although it is gradually ticking up. Certainly in the short term, it's very, very low. The IV values are very low. They're in the 50s, they're in the 40s. They're at 5-year or more lows. I can't recall a time I've ever seen a single week's implied volatility below 50 for GameStop. I can't recall a time that I've seen that. Probably had some maybe going back to like early 2020 or late 2019 or something like that. But there's no time that I can really remember. I haven't been beyond 5 years. That's essentially forever for me in terms of my history looking at this options data. But so what's that going to mean? Well, it means that under sort of normal price action behavior, 23 is going to operate as a very resistant level, right? So calls, the accumulation of call gamma is going to act as a resistance point as it's approached. Intraday, it's going to, it's a resistance or support point depending on the direction that it's approached. So while it's serving as our call wall, while it's approached from below, if options traders are going out there and buying options, that market maker hedging is going to run into this position and then basically get stopped. It'll kind of scrub at that level. It'll bounce off. And then traders can use that to then push us back towards the downside. Whereas you can see, right, it does not require much capital commitment to kind of easily move the price between, let's say, 23 and these 22 position here. So there are other factors involved which may prevent us and have prevented us from going too much lower that have to do with the fundamentals of the company. But really, it's kind of easy to push things around there, and then you can get all of this built up short call gamma, especially expiring out of the money, which makes anybody who's short contracts in that level very happy. But what's very interesting is if we do overcome this, if we do see a continuation of hedging related buying externality that moves the price over that $23 level, then that could stimulate a significant amount of options market maker hedging that would buoy us up and see us trade maybe slightly over 24, kind of into this hedging dead zone between 25 and 24, probably south of 24.50. But we could see some of that, which would stimulate a bit of volatility that then the options market maker or option sellers could then go package, sell in the options market, and then crush basically into August OPEX and coming out of August OPEX for maybe about a week and a half. Certainly not until after the 22nd. They could crush some of that into the 22nd, coming out of the 22nd, maybe again over the weekend, get some crush on Monday the 25th, Tuesday the 26th, before 27, 28, 29. We kind of start to, maybe even into the 29th, before we start to see some of that IV lead up effect start to set in with respect to Q2 earnings, which of course are happening on the 29th. So that's what we're looking at. That's what we're looking at today. Certainly nice to see a little bit more excitement hit the tape. Nice to see institutions really start to move here. We're getting close to the end of the dog days of summer officially, by the stars. That doesn't stop until the 23rd. But it is nice to see a little bit of movement after quite a lot of sideways, a lot of side scrolling here. So yeah, very, very interested there. Like I said, do go ahead and check out some of this material from Ultimator. Do give him a follow. He puts out really awesome stuff. Great kudos over to him. Check out his post. Go ahead and check out some of the discussions we had here, both on YouTube and on my X page. Again, these are linked down in the description of this video for your enjoyment. So yeah, looking forward to seeing you guys tomorrow for our last open interest breakdown of the week, and for our live stream, which of course always is back and happening at 4 p.m. Eastern time after market close. So looking forward to seeing all of you there. Thanks so much again for watching and listening. And yeah, we'll see you guys tomorrow. Take care now.